Imagine you're standing on a crowded trading floor in the early 1920s. The air is thick with the smell of cigar smoke and the frantic, rhythmic clicking of the ticker tape machines. It's a chaotic, loud, and high-stakes environment where fortunes are made and lost in the time it takes to read a single line of printed numbers. This is the world of Larry Livingston, the protagonist of Edwin Lefevre's classic, Reminiscences of a Stock Operator. While the book is presented as a memoir, it's actually a roman à clef, a fictionalized account of a real person. Most historians and traders recognize that Livingston is a stand-in for Jesse Livermore, one of the most famous speculators in history. Through Livingston, Lefèvre gives us a window into the psychology of the markets, not through complex mathematical formulas, but through the lens of human behavior. The story begins when Larry is just 14 years old. He isn't a trader yet, he's a lowly quotation-board boy in a brokerage office. His job is simple: keep the prices updated on the board so the brokers can see them. But while the other boys in the office are interested in the companies themselves, or perhaps just looking forward to the end of their shifts, Larry is mesmerized by the ticker tape. He becomes obsessed with the way the numbers move. He notices that a stock can drop even when the news is good, or rise even when the news is bad. This is his first major realization: the why of a stock's movement, the actual news, or the company's fundamentals, is often secondary to the how of the price action itself. He realizes that the tape is telling him a story about people, not just about companies. To make sense of this, Larry starts doing something that separates him from every other amateur. He keeps a meticulous memorandum book. He records every trade he sees, every price movement, and every prediction he makes. He doesn't just look at what happened, he looks at how it happened, and compares his expectations against the reality of the tape. He's essentially building a laboratory of human psychology, one line of ticker tape at a time. His transition from a curious observer to an active participant happens quite suddenly. An older office boy mentions a tip about a stock called Burlington. Most people would take that tip and run to buy, but Larry doesn't. He goes to his notebook. He looks at how Burlington has behaved in the past, during similar price movements. He uses his data to validate the tip. He takes his meager savings, makes the trade, and walks away with a profit that feels like a fortune to a teenager. That moment is the birth of his methodology. He realizes that successful trading isn't about being right about a company, it's about being right about the movement. From there, the narrative follows his rapid ascent. He leaves the quiet brokerage office for the high-stakes, high-risk world of bucket shops. These were establishments where you could bet on price movements without actually owning the underlying stock. It was a dangerous, unregulated way to trade, but it served as Larry's training ground. He amasses his first $1,000, then more, moving from a novice to a seasoned, wealthy operator. As he climbs the ladder of wealth, the scope of the book shifts. We see Larry move from the frantic betting of the bucket shops to the sophisticated, high-level manipulation of the New York Stock Exchange. And this is where the book gets its most profound insights. As Larry becomes a big operator, he begins to see the machinery of Wall Street for what it really is: a battlefield of information asymmetry. He realizes that the market is not a rational, efficient machine designed to find the true value of a company. Instead, it is a place where insiders, promoters, and large-scale operators use misinformation to move the crowd. He watches as news is timed perfectly to trigger a sell-off so that big players can buy at a lower price, or how rumors are spread to pump a stock up so they can exit their positions. He learns that the public is often the last to know the truth, and by the time the news reaches the average investor, the move is already over. This leads us to the core philosophy of the book: the distinction between the gambler and the speculator. The gambler is the person who follows the tip, who reacts to the news, and who acts on emotion. The gambler is always one step behind the market. The speculator, however, is the person who observes the movement, recognizes the pattern, and waits for the trend to confirm itself. Larry learns that you don't need to know everything that is happening in the world to make money. You only need to know how the world's reaction to that news will manifest in the price. As the story progresses, we see the psychological toll of this life. Larry becomes incredibly wealthy, but he also becomes acutely aware of the cyclical nature of human emotion. He observes that markets move in waves of greed and fear. When everyone is greedy and the prices are soaring, that is often the moment of greatest danger. When everyone is paralyzed by fear and the prices are crashing, that is often where the opportunity lies. He realizes that because human nature doesn't change, the patterns in the market don't change either. Greed and fear are constant, which means market cycles are inevitable and repeatable. The book doesn't end with a sudden dramatic crash or a single final trade. Instead, it concludes with the establishment of a complete worldview. By the end of his journey, Larry Livingston has moved from a boy staring at a ticker tape to a man who understands that the tape is a mirror of the human soul. He has mastered the ability to sit on his hands, to wait for the trend, and to ignore the noise of the world in favor of the signal of the price. If we step back from the story and look at the analysis, several timeless lessons emerge. First, there is the concept of the ticker tape as truth. In a world filled with conflicting reports, opinions, and expert predictions, the only objective reality is the price. The news tells you what people are thinking, but the price tells you what they are actually doing. Second, there is the lesson of discipline. Larry's success isn't built on being a genius or having a crystal ball. It is built on his memorandum book, his commitment to a systematic, documented approach. He understands that the market is a place where the undisciplined are harvested by the disciplined. If you trade based on how you feel or based on what you heard at a cocktail party, you are essentially gambling. If you trade based on a proven, recorded methodology, you are speculating. Third, the book provides a sobering look at the structural realities of the financial world. Even today, the concept of information asymmetry remains. While the regulations are much stricter now than they were in 1923, the fundamental reality remains. Those with more information, or those who can interpret the movement of information more quickly, will always have an edge over the general public. The book is ultimately a study of the struggle between human instinct and human intellect. Our instincts tell us to run when things are falling, and to jump in when things are rising. Our intellect, if we are disciplined enough to use it, tells us to do the exact opposite. Lefèvre's writing is remarkable because it avoids being a technical manual. He doesn't give you a set of rules for how to read a chart or how to calculate a margin call. Instead, he gives you a study of character. He shows us that the greatest enemy a trader faces isn't the market, or the big banks, or the government, it is their own psychology. The market is a giant machine designed to trigger your fear and your greed, and if you cannot master yourself, you will never master the market. As we close this look at Reminiscences of a Stock Operator, we see why it remains a foundational text for anyone interested in the markets. It's a story about the pursuit of truth in a world of noise. It's a story about a boy who looked at a flickering piece of paper and saw the heartbeat of human emotion. And most importantly, it's a reminder that while the technology of trading changes from ticker tape to digital screens, the people behind the trades remain exactly the same.